special meeting of the Budget and Finance Commission to order. We'd like to start off with a roll call.
Commissioner Allen?
Here.
Commissioner Jesty?
Aye.
Commissioner Martin is absent. Chair Castle?
Here.
Commissioner Woodham?
Here.
Commissioner Samples is absent. And Commissioner Sherbin?
Here.
Thank you. Next, I'd like to have a motion to approve the order of agenda.
I think we do a salute to the flag first.
Sorry, jumping ahead of myself. Please stand. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Okay, next item, we'd like to approve the order of agenda. Do I have a motion to approve the order of agenda?
So move.
Second.
Aye.
Aye.
Okay, all in favor?
Aye.
Next, Doug, do we have any blue folder items tonight?
There's no blue folders. There are no blue folder items for tonight's meeting.
Okay. Next on the agenda is the consent calendar. We have the approval of affidavit for the posting of this special meeting tonight, and then also the approval for the minutes of the regular Budget and Finance Commission from October 12th of 2023. Do we have any changes on either of those, or do I have a motion to approve the consent calendar?
Move we approve.
Second.
Okay. All in favor?
Aye.
Next on the agenda, excluded consent items. There are none. Doug, are there any public participation or non-agenda items tonight?
There aren't any public participants on Zoom for this item, and nothing for e-comments.
Okay, thank you. Next, we have items continued from previous agendas, and tonight there are none. And that brings us down to J, which is items for discussion prior to action. Tonight, we have the discussion of possible action regarding the annual financial reports for the fiscal year ended June 30th of 2023. And our finance director, Wendy Collazo, will take us through those numbers. Wendy, the floor is yours. I'm sorry?
I'm just waiting on a mic.
Oh, okay, sorry.
He's got the magic touch. Good evening to the commission, Wendy Collazo, Finance Director. As is typical, this special meeting was obviously for the presentation of draft financial statements for the 2022-23 fiscal year. We have online our LSL auditor, Mr. Ryan Domino, who's actually going to give an overview of the entire financial statements and the process of audit this year. And then I can answer any questions, as well as he is open to any questions that you will have relevant to his slide decks. And so we'll try to get him on the line here and begin this discussion for you, and we'll put the slide deck up for you.
Okay, terrific.
Thank you, everybody. I hope you can hear and see me okay.
Yes, we can.
I will go ahead and get my slide deck up and presented here. Okay, I trust this is coming up on everyone's screen?
Not yet.
Not yet.
Not yet? Okay. Let me know when.
Oh, yay.
We're good?
Yes, we are.
All right, excellent. Well, good evening, everybody. It's a pleasure to be here with you tonight. First thing, right out of the gate, I am going to apologize if my voice gives out or I end up coughing at any point during this presentation. I'm recovering from the flu, so you'll have to bear with me if any unexpected mishaps happen here. So according to the introduction, my name is Ryan Domino. I'm a partner with LSL CPAs, and so we are just about in the wrap-up stages of the audit. We expect to issue our final reports very soon. So tonight, I'm just kind of going to go over the financial audit process as well as a few of the financial highlights. Again, please keep in mind that these are draft numbers. We don't expect anything to change really, but just keep it in mind. All right, so the first thing I always like to talk about is what is the scope of our engagement? What has the city hired us to do? So we have been engaged by the city to perform a financial statement audit in accordance with generally accepted auditing standards and government auditing standards for the year ended June 30th, 2023. I always like to point out the difference between generally accepted auditing standards and government auditing standards. Generally accepted auditing is basically the baseline auditing standard that every CPA firm who audits any organization in any industry has to follow. So think of it as like the bare minimum audit requirements. Government auditing standards are a step above. The city being a governmental organization, there's additional procedures that we have to do to make sure that we're conducting the audit appropriately. These include looking at internal controls and offering not an opinion on them, but feedback and identifying if there's any significant deficiencies or material weaknesses in them. And then also we have to look at compliance with laws, regulations, grant agreements, bond covenants, those types of things. So that's the additional, assurances that you get with government auditing standards. The whole objective of the audit is to render an opinion on the reliability and compliance of the financial statements with generally accepted accounting principles. So the idea is to let you have assurance and peace of mind knowing that the numbers that are presented to you are accurate and can be used for decision-making purposes or submitting to grantor agencies, what have you. A couple common misconceptions about what an audit is that I always like to dispel at the start of these presentations is I'm not here to tell you whether or not the city is improving or getting worse financially. The only time I would ever bring up in any of our reports a financial operational, and net income going up or down or something like that is if we believe that there is a severe financial strain that is going to be, coming up in the next 12 months or so, in which point we would be required to report that. The other objective, and this is probably the more common misconception, is that as the auditor, it's my job to dig in there and I'm hunting for fraud. That's the number one thing I'm looking for. And that is actually not the case. The idea is to make sure that the numbers are accurate and we do consider the risks of fraud and we perform certain tests to, keep our ear to the ground, so to speak, for fraud. And we would obviously report it if we encountered any, but hunting for it specifically is not the objective of the audit. So just a little bit of backstory about what we did this past year. We conduct our audit in 2 phases. The first phase we call interim, and that happened in August of last year. During that time, we examine internal controls. We provide feedback to management based on our observations of those controls. We use the data that we gather to conduct a risk assessment, basically where we identify areas that we're going to spend the majority of our time auditing and other areas that maybe we don't need to look as closely at. And then we will plan our year-end audit procedures to respond to those risks that we identified. So we came back and conducted what everyone considers to be the audit, where we were looking at bank reconciliations, pulling checks, invoices, confirming things with third parties, the nuts and bolts of the audit, so to speak. We did over 3 weeks in late November and through mid-December of last year. We do the detailed testing of account balances. We perform our compliance testing with laws, regulations, and grants and debts, things like that, as well as any other procedures necessary to obtain sufficient appropriate audit evidence. So like I mentioned, we have not issued our final auditor's reports yet, but I can tell you we have basically concluded our audit testing. And so we're working up and we're drafting up our final reports pretty much as I'm speaking. And we do plan on issuing an unmodified auditor's opinion on the financial statements. This is pretty much going to be the best and highest opinion that the industry allows us to render. You have unmodified, which means everything was good, modified, which means everything was good except for this, and then you have adverse, which means don't believe anything in this document. So unmodified is what you want, and that's what we plan on issuing. We're also going to issue, along with that opinion letter, our report on internal control and compliance. This is the report that's required by government auditing standards, and we do not have any sort of significant deficiencies, material weaknesses, or material non-compliance that we identified during the audit. So that letter will also be a clean, short little report. In the future, so probably in the next month or so, we're going to start working on the city's single audit. So this is the greater purpose of the financial statement audit, is to include it in the overall single audit of the city's major federal award programs. So this one is in the future. We plan to have it done this month. It has a March 31st deadline, and during that we will most likely issue an unmodified report on federal award programs. Fingers crossed. But like I said, we have to actually start that one. The one that is also in the works, scheduled to be issued here pretty soon, is the Inmate Trust Fund, and that one will have an unmodified auditor's opinion. So just a few other things that we always have to report in these types of meetings is if we had any going concern out. So did we have any indication that the city would undergo a severe financial hardship in the next 12 months? We did not, so that is positive. We identified no sorts of fraud or waste or abuse during the fiscal year, and nothing was brought to our attention by employees of the city that would be indicative of that happening. We didn't have any disagreements with management about the application of accounting principles. There was actually a fairly significant change in accounting principle that happened this year, and I'll talk a little bit more about that in my next slide. But we implemented it and had no disagreements about how it was implemented. We did not have any difficulties conducting our audits. Management has provided us everything we needed to conduct our audit in a timely manner. And so to that end, we really do appreciate their cooperation. And finally, we do evaluate all the estimates that go into preparing the financial statements. So pretty much the two most significant estimates that you see in the financial statements are the estimate for your pension liability and your other post-employment benefits liability. These are prepared from CalPERS actuary as well as actuaries hired by the city. And we review all the data that is sent to the actuaries to make sure that they are getting good, reliable data with which they can create their estimates. Okay, so the big change that happened from the prior year, and this is not unique to the city of Redondo Beach. Every government across the United States had to implement this year. It's GASB 96, or Government Accounting Standards Board Pronouncement 96. And it relates to subscription-based information technology arrangements. So think of these as like if you have a software that you have a subscription to for multiple years, you now have to record a liability for the future payments on that subscription, and then recognize an asset, an intangible asset for the use of that software. It's very, very similar to the lease standard, which was implemented last year. It just takes into account, instead of a physical asset that's being leased, it's now a software that's being leased, for lack of better words. And so the result of this that changed in your financial statements this year is you're going to see a net subscription asset recorded on the books in the amount of $1.2 million. And there is an offsetting liability for the remaining subscription payments. About $1 million. So just wanted to point that out. That is a change this year, and you'll see that going forward. And finally, just a few other financial highlights that I would like to go through. The big things are always the general fund, capital assets, long-term debts, and pensions and OPEB. So as far as the general fund performance went, we did see an increase in general fund balance of about 3.8 million to 33.2 million at the end of the year. So a increase in the general fund is always a positive. That was good. The spendable reserves, so that is your assigned fund balance and your unassigned fund balance, represented about 27% of annual expenditures and 74% of total fund balance. So what these are both positive numbers as well. The minimum standard set by the GFOA for reserves in the general fund is they typically like to see about 16% of expendable fund balance being representative of expenditures. So the city's at 27%, which is well above the best practice by the GFOA. General fund expenditures came in about $8.6 million under budget. Capital assets increased about $26.7 million, primarily due to increases in construction in progress. Long-term debt went down a little bit up to $7.7 million just due to some routine debt repayments. However, the big one that actually changed quite a bit this year, and you guys actually went in the opposite direction of most cities that I've seen, is the pension liability for you decreased about 113 million, which is actually spectacular since most cities saw a massive increase in their pension liability this year.
Excuse me for interrupting, could you discuss what that pension liability is? I'm not aware of a liability that decreased 113 million during the year. What was it?
Yes, so the city has a net pension liability on the books. It's been there since I think probably about 10 years now. And so last year, I believe the city made a large contribution, about over $70+ million in just for one of the plans. And this year, because CalPERS is 1 year behind, they look at everything. The city's in 2023, but all the numbers are reported as of 2022, just because of the timing differences for CalPERS. So they finally recognized that contribution that the city made, and the city's pension liability went down considerably in the financial statements as a result. Can probably show you where it is in the draft once I'm done with the PowerPoint. I just have one monitor at the moment. And then finally, the OPEB liability increased a little bit, $1.6 million, and that was due to a lackluster CalPERS return on investment from 2022. So that's pretty standard for most organizations. So at this point, I'm happy to take questions or walk you through the document. That is my presentation.
Have you been auditing any other cities' financial statements?
Yes, no, so personally, I work with approximately 35 cities. And
Are
then
there,
as a
are
firm,
there any, yeah, go ahead, sorry, go ahead.
Oh, I was just gonna say, as a firm, we have about approximately 100 clients.
Are there any best practices that you can think of that we can follow just to see how we compare against them? And if we need, or if we can make some improvements?
So best practices in terms of, do you have something in mind in particular or just in general?
In general.
In general. Yeah, so I think one of the things that, and this is probably true for a lot of organizations, so just in the interest of full disclosure, I took over as the audit partner about halfway through this audit. So a lot of the stuff that happened at interim, I reviewed after the fact. Some of the best practices that I would recommend though are pretty consistent. So the city, they have had a little bit of struggles implementing, new GASBs and stuff like that. And that's very common. And so some of the steps the city has taken, they've gotten outside help. The reason I took over in particular is because the previous partner now helps them close the books and get things in order and do some of the more advanced journal entries. So I think just, being open to finding, resources if it's not capable to be done inside, that's probably best practice. As far as controls and policies and procedures, it's all pretty consistent with most of the other organizations that I see. Nothing jumped out at me as needing significant improvement as I reviewed the work we had done. I hope that answers your question.
But there must be room for improvement because that the process of continuous improvement
Yes.
goes on all the time. So if you can highlight some areas that could be improved, I think it'll help the city.
Yeah, no, absolutely. We can provide a detailed summary of recommendations and stuff like that. once we finalize our reports. But as of right now, I don't have all those notes in front of me, so I would have to go back and get that to you. You're more than welcome to shoot me any emails outside of the questions. I can have the finance director provide my contact information if you want.
Now, you also mentioned subscription service. Is that a departure from what we have done in the past? So this is something new for 22, 23?
Yes, it is. It's very much a new thing. It took effect in 2023, and it is a new accounting principle that all governments have to follow. So you will see it going forward, but you won't see it in any previous financials.
So is it cloud-based and is something?
It can be cloud-based, yes. So that it can be software as a service, infrastructure as a service, and there's a third one that it covers, but I can't remember exactly what the terminology is for it. But pretty much any software or IT system that the city does not actually have the physical asset to, they just own the right to use the software via the cloud or something like that. That's what it covers.
So does that expose us to more, a greater possibility of cyber attacks? Because now we're connected with another cloud-based service.
No, not necessarily. This accounting principle has nothing to do really with cybersecurity. It really just is for the accounting of those types of cyber assets, if you will. You know, the cybersecurity stuff, that's a little bit outside of our realm of expertise as financial auditors. I wouldn't really be able to give you a lot of detail on that.
Thank you.
Mm-hmm.
Yeah, I have one follow-up question on the pension liability. I'm still not sure that I understand this. We had unamortized accrued liability of something like 225 million before we did a bond issue. Now, is this a reflection of a reduction in that liability, or is that a different liability that you're talking about? I'm not aware of. Annually, we have a contribution that we make, and I suppose when that contribution is determined, that becomes a liability, but I'm not aware of any other liability other than the UAL.
Right. So CalPERS calculates a liability that factors in the UAL, but it also factors in the number of employees the city has, mortality, retirement rates, a whole number of things, and they create a total pension liability that the city owns. Because the city is part of CalPERS, the city contributes to it, those payments that are made every year create what's known as a fiduciary net position in CalPERS. So CalPERS has a bucket set aside for the city of Redondo Beach where all the money to pay the pension is being accumulated. So when the bond was issued last year, or a couple of years ago, the money was sent to CalPERS, right? So CalPERS did not actually recognize that money until this year. So when they recognized the money, the pension liability decreased significantly. It did not go away entirely. But as of right now, I'm just looking at one of the plans. So the miscellaneous plan here is now showing at about 97% funded. So it didn't go away altogether, but it went down drastically because CalPERS finally recognized the additional funding that they received from that bond.
So this is a recognition of what that liability was 2 years ago? I mean, I'm still not following exactly this calculation. I think as members of the Budget and Finance Committee, we should be able to we should have a better understanding of what you're discussing here than I do right now.
Okay. If you look in the financial statements, I can walk you through a brief example on pages 73 to 74 in there. It shows the miscellaneous plan. So the reason that there might be a little bit of confusion here is because of time. So CalPERS, when they send the city all the data to prepare this information, it is 1 year behind. So even though it's the 2023 city financial statement, all the pension information in here is actually as of 2022. And it's just due to when CalPERS is able to provide the information, when the dates of their reports, things like that. So even though the bond was issued in prior years, and it's just now being recognized in the books as a reduction of this liability. So last year, in the 2022 financial statements and the miscellaneous plan, there was approximately $40 million. This year, the miscellaneous plan is only showing about 8.2. So it went down quite a bit, and it's simply due to the timing. I can see that CalPERS recognized about $71 million of city contributions, and that's the bond.
Well,
I have a question.
everyone else may understand this, and I still don't, because we
don't either.
we did $225 million of debt. Now, the liability, if it were measured on the day we did the bond issue and the day we wrote the check to CalPERS, there would have been no liability to CalPERS, so we would have reduced liability by 225 million, or whatever the amount was, is between 215 and 225. So what you're talking here, you're talking about a 1-year delay. So we did the bond issue in June of 2021.
Mm-hmm.
So for fiscal, or July, it was after the fiscal year, I think. So we would have had, if there's a 1-year delay, then what you're talking about here would be as of, basically as of the end of FY22. You did it in 23. So I mean, maybe we should ask Wendy to cover this in detail, but I'm totally confused as to the amount you're showing us, that liability that was reduced, because I didn't think we even had a liability at the end of fiscal 22. It was taken care of at the end of fiscal 20. I guess we created an additional UAL during fiscal 22, but I didn't think CalPERS could tell us even today what that liability was. So I'm not sure how we calculate a reduction in that liability.
Well, the other piece of the puzzle is just, even though the bond was issued and it was sent to CalPERS, and that should have reduced the liability as of the date that it was issued, right? Because you paid CalPERS the money. That total liability is remeasured every single year by CalPERS actuaries. And CalPERS had a terrible year in 2022 for return on investment. I'm sure we're all very aware of that. So every other organization that I've audited this year has seen their pension liability basically skyrocket. And really the only reason that yours has stayed relatively low and has been reduced is, even though it went up technically, because CalPERS return was absolutely atrocious last year. It would have gone up otherwise, but for the fact that CalPERS, on their side, in their timing, they finally recognized that bond. So I'm sorry, we might need to have an additional discussion on this, but I'm doing the best I can here.
And Commissioner Woodham, I think that we can, we may need to take it back for our next meeting, but we can give you a good crosswalk, or we can follow up with an email between the numbers that you're seeing in here and what we've presented. I think an additional confusion is that what we have presented to this commission when we speak about the UAL is just the unfunded accrued liability. I believe what we're showing here in our financial reports also includes a calculation of our liability related to our current employees. Mm-hmm. So it's going to be a different number that we haven't seen. It's not a different liability, it's just a different way of looking at it. And the $113 million decrease that Ryan is mentioning, similar to what we've talked about with the pension before, is the difference between our large payment followed by the increase in liability related to the poor investment returns. So while the number is different than what you've seen, it's the same thing that we've been talking about. It's just a slightly different view of that. And Ryan, you can correct me if I misstated something there.
And if I may, let me see if I could put it in layman's term, because, I'm an old school Marine, and so let's see if we could do just arithmetic, right? So you get two levels of perspective, and we're using liabilities. You're seeing a liability as UAL. That's what you care about. That's what you've always heard, the bill that is due, right? What we haven't funded. This is reporting the current period up to June 30th, 2023, if we had to pay those obligations to our employees for this period, 1 year, not the UAL, not what's due later. It's right now to pay retirement people that are coming in your 3 tiers that you're seeing. That's what this is measuring, not the UAL and additional liabilities, because we still have a liability, right? Somebody could retire. So through the year, what we have, what we owe them, the funded side, what have we funded? So your financial statements are reporting on the liability that exists on the current staff for this 1 year. What's going to happen right now? How did it affect this 1 year period that we're auditing? If all the wheels fell off and everybody who was due retired right now, we would have to fund this. That's our liability, not UAL. Right? When we talk about investments and UAL and CalPERS, what has happened, right? That is your UAL moving forward. But here we're measuring, again, what is due and we are liable to pay to our staff in the current period measured for July 1st, 2022 to June 30th, 2023. We're using that liability that makes us like, all we think about is UAL, because this committee's been like, we made this big payment. We shouldn't have no bill, right? That's not what this is fully measuring.
But UAL is that figure. If, in fact, the world stopped on June 30th, then our UAL as of that day measures exactly that. That's the difference between what we've paid in and what we owe. If we paid everyone what they were due at that point, the difference between that and our assets is UAL.
Correct. But as we're, I hear the confusion on a liability, as if I don't want to have this commission leave here thinking there's an additional liability. You're correct. It is the net effect of all of that measured for this period. Yeah, like I said, I already heard wait a minute, do we have another bill? No, we do not. It is the combined and net, just like you're saying that, of the retirement pension liability, right, as a whole. We know that our funding levels have changed now, and that's why we've reduced it. So our funding levels, you hear that 97, 93 level of funding. This is reflective because the timing, which has been I think the number one thing we have said to everybody on this commission, timing, right? As you can tell, when you read Note 12 will walk you through for pension, like we use this valuation, right? 1 year behind. Here comes the payment. Yes, checks were written, but the effect to the assets didn't happen until this period now to where it's booked and recorded. Right? Last year, on your financial statements, we had to defend the inflow because we had the bond money, in financial statements, right? They were like, what's this money for? Now, pretty much here comes the year and we're classifying this money, hey, this money went in and went out, right? Towards what we paid. And we can update that a little bit more if you'd like, more clarity, because I don't want anybody kind of nervous here. I think we're talking the same thing. It's just.
I understand that. I think from my standpoint, the calculation that will be helpful is if we're looking at UAL as a point in time, and then the calculation from CalPERS is a year delayed. So you're looking here at the difference between the end of fiscal 22 and the end of fiscal 23. And we haven't seen that UAL yet. And that is a point of confusion because, again, I didn't think CalPERS even knew what that was at this point. So I'm not sure how, but seeing that calculation, walk us through the next meeting, how the UAL at the end of the year and what we paid and how we came up with this figure.
Okay. Yeah, and we can do that because we can cross it over as to we had total for the period at the end of this fiscal year, we had about $226 million recognized where we lowered our net position liability, right? What we owed as an employer, which are all the contributions that we're saying. Then you come in with the valuation of the assets 1 year behind, right? Focusing on the payment that we made towards those assets, but definitely.
A question on that. When we're short, we pay CalPERS 6.8% or 7%. We paid them, and then that calculation of a reduction in liability came forward 12 months or 24 months. Do we earn a credit on what cash they have that they haven't reduced our UAL by? If we're paying them when we're deficit, they should be paying us when we're in surplus.
I got to think about that. My quick answer to that is
Maybe.
no, because we're looking at it from a short term, right? This is the long term of the liability and the asset of this, right? So, no.
I didn't mean to just derail us on that, but.
No, that's okay. But no, I would say no, it's not a credit them when they get it and then, or credit us when we don't, because the entire portfolio is looked at as its performance over, well, more than multiple years. It's just we're taking a snapshot of 1 year. Where did we land right there?
Yeah.
Right?
I know, but they had our 225 million in hand and they didn't reduce our UAL until sometime later. So we should be getting a credit for, we should be getting some sort of credit for that calculation of the, and I'm sure that that's a multi-layered calculation, but we can address that later.
Okay. Sorry, Ryan.
No, you're good. Any other questions on the audit or audit process?
I don't know if this is a question for you, Brian, or for Wendy. My question is from the PDF file that you guys sent us yesterday. And I'm assuming this is where Ryan got the information to put on a presentation. On page 22, would you be able to go over and briefly explain to us those non-current liabilities? Because there's almost 300 million of them, especially the long-term obligations doing more than 1 year, 220 million. So that's page 22, middle of the little 3/4 down of the page. Under liabilities, there are liabilities and then there are non-current liabilities.
Page 22 of the financial statements or?
The PDF that you sent yesterday,
Oh,
what are those non-current liabilities? If you can go through each one and for us too, because some of them are really large numbers and I just don't know anything about them.
Ryan, would you like to go through non-current liabilities and I'll tie it in with how it relates here to the city, if you want to?
Just to confirm, we're looking at the same thing. The header on the top of the left of the page says statement of net position.
Yes,
Yes.
Okay. All right. So those non-current liabilities down there, those are all of the city's long-term debts. Think of it like that. So you obviously have your net pension liability that we've been discussing. There's the net other post-employment benefits liability. The compensated absences, these are the city's like vacation and other PTO that is accrued for employees to use. The claims payable, so these are the estimated amounts of legal settlements, lawsuits, those types of things, insurance claims, all aggregated in that amount. And then the long-term obligations due in more than 1 year is primarily the bonds. So that is, I hope that kind of clarifies what each one of those.
Oh, okay, that's the LRB that we borrowed. Okay.
Yes, ma'am.
LRB, okay, and so the other day, the 27 million would be the UAL? Net pension liability due in more than 1 year.
Yes, so this, like Wendy mentioned, if that's the amount that if every employee in the city retired today, how much would the city have to pay out to meet the retirement obligation of those employees, basically. Or not today, but June 30, 2023, I should say.
And the net OPEB liability would be, is that included in the, it's not included, that's excluded from the net pension liability.
Correct, it's different. So instead of pension benefits, these are healthcare benefits typically for retirees.
Those are your other post-employment benefits. That's what the OPEB is for.
So the first one is the current employees and the second one is the retirees.
So the first one would include both active and retired. It does include both of those numbers include active and retired.
But the net pension liability is pension and the OPEB is for the medical and other benefits. So they're different benefits.
They're different benefits, yes.
So this is not a segregation of active and, not and retirees. It's the combination of retirees already in the retiree pool and those that are expected to retire. And it is just defining their pension benefit and then the OPEB benefits that they will be entitled to for the entire census as of June 30th, 2023.
And that's almost, so those two together are almost 40 million. And this is for the lifetime, not just for 2023.
Correct.
Right. Mm-hmm.
For them to receive.
It's confusing for us because we're used to seeing just the 2023 numbers and annual numbers, but these are the lifetime numbers.
Right, because it's your net position, right? So.
Thank you. That's all I have.
Okay. Any other questions? Nope. Okay. All right. Thank you.
Thank you.
Lynn, back to you.
Yep, absolutely. I just, if I could, thank you, Ryan. I really appreciate it. I just wanted to make some mention and just kind of give this commission a little bit of, 75,000 foot view of this financial audit, where we stand and as it correlates to you. So you kind of get our picture and also recognize some of these, warriors out here, right? One of them being LSL, who has definitely, due to transition, institutional knowledge, walking out of here, they've not only supported us on the auditing side, but consultative services, helping us with MD&A, actual journal entries. The finance team, just with new, existing, have back-to-back in less than a year, done 2 audits to catch up and implemented 2 large GASB 87, GASB 96 implementations through debt book for leases and subscriptions, which may seem like nothing, but it is a huge undertaking with what they've had to do. And we are now at RFP. We've received some RFP packages and getting ready to do that. And we will jump again in March to be on schedule like Ryan had outlined so that we can be done and back on your cyclical schedule of December. Overall, the audit, one of the other accomplishments this city has done is that any recommendation that you had last year, if you look at your audit, which was, hey guys, you got a lot of people that left here with institutional knowledge, senior management, you should fix that, watch that. We have corrected that and had no findings or recommendations on that. And again, it's a tribute to this team, and what they've done. Again, LSL, we couldn't have done it without them to continuously just, we had people like Ryan who picked up in the middle and was kind of like, yikes, where are we at? Yikes here on this side too, because, Stephanie, Doug, everybody, we had a new senior accountant come on board. And like I said, I just wanted to tell them thank you. Tell this commission thank you for your patience as we just deliver this product. But we're so close to just be, we got to kick off again, but we'll be on a cycle that is more routine. So I really appreciate that and your support.
I am so sorry. I have one very quick question. So the slide over there, the one of the very last slides, it says pension liability decreased 113 million. To what? So what is the current number?
That's because you don't have the MD&A attached to this. I'll give you the number right now.
Yeah. That's
Thank
what
you.
it
I'd actually just closed the PDFs.
Yep. Would you like me to give you that note, like with those numbers and stuff? As I look through it, I'll give you what it actually was, if you give me a second. Yeah.
Should be just one number, right?
Yeah.
Okay, yeah, I'm just curious what our final number is.
Well, you're going to get, yep.
Okay,
I'll give it to you.
that's all. Thank you,
problem.
that's all, sorry. I thought it was gonna be easy one.
We'll give her just a second. Please.
I actually got it.
Oh, thanks. I was just like one page off.
You're welcome. So the total pension liability that's currently what it reduced to for all plans is 30,797,313.
30 million?
30 million. Mm-hmm.
Okay, so that's all we have is 30 million now. Okay,
Correct. Mm-hmm.
that's pretty,
And like I mentioned in my presentation, for a city, most cities comparable to you guys are way underwater in their pension. So to be 97% funded, even with a $30 million liability
that's
is
really good.
yeah.
80/20 is the industry standard I have seen in over 25 years doing this business. 90s, it was a dream. I never thought I'd see it. I mean, it's in California. It's a fantastic feat,
That's,
truly.
okay, thank you.
Okay, thank you. Wendy, is there anything else in your presentation?
No, sir, thank you for hearing us out.
Okay.
And Ryan, again, thank you so much.
Yes, thank you, Ryan.
Yeah, my pleasure.
Commissioners, any other comments? Okay. Do I have a motion to receive and file this draft financials?
So move.
Do I have a second?
Second.
Doug, could we do a roll call, please?
Before we do a roll call vote, for the record, there are no public comment on this discussion item. Nothing on, no e-comment and no participants on Zoom. Commissioner Allen,
Aye.
Commissioner Jesty,
Aye.
Chair Castle,
Aye.
Commissioner Woodham,
Aye.
Commissioner Sherman.
Aye.
Thank you. Are there any member items or referrals to staff?
Just the pension liability issue. Again, if the auditors are showing a reduction in pension liability through the end of fiscal '23, my understanding is that CalPERS hasn't even calculated the UAL at the end of fiscal '23 yet. So I don't know how they're doing a net reduction of, or calculation of that pension liability. They can't do it without CalPERS information. And CalPERS hasn't done the calculation yet. So again, just underlining, let's have that discussion at the next meeting, because we did the bond issue at the end of fiscal '21. The first reduction of that on CalPERS calculation would have been at the end of fiscal '22, and then another calculation at the end of fiscal '23. If those calculations are 2 years behind, then the sequence of the calculation and the reduction of the liability, that I think we need to see in a simple spreadsheet. And it's escaping me right now. It's also escaping me how the auditor knows that UAL at the end of fiscal '23 when CalPERS hasn't calculated it. So we need to know that.
Okay.
Any other comments? Do I have a motion to adjourn the meeting?
Second.
All in favor?
Aye.
Meeting's adjourned. Thank you.